Welcome to Market Call. Our guest is Andrew Moffs, Senior Vice President and Portfolio Manager at Vision Capital, and he'll take your questions on real estate stocks, real estate investment trusts. Call them toll-free, 1-855-326-6266, or send an email to marketcall@bnnbloomberg.ca. We'll get to Andrew in just. Andrew Moffs is our guest, taking your questions on real estate investments. Andrew, it's great to see you as ever.
Thanks. Great to be here.
What is the biggest thing in real estate right now? Is it the impact of rising rates?
What we always say is that it's really about economic activity. What's really interesting, and it's hard to argue this given what we've seen in the market year to date, is that interest rates and real estate, there really isn't a correlation. It's all about economic activity. So, of course, interest rates are going higher because we're seeing rapid inflation. We're seeing a general economic slowdown. And so if I'm talking about economic activity, you really want to position yourself in real estate in defensive asset classes, which we can talk about, whether it's certain sectors of residential, whether it's industrial, or whether it's grocery anchored shopping centers, for example.
That's interesting. So it's economic activity, which of course does tend to get curtailed when rates rise, but it's not rates itself.
That's right. It's like any business. It's all about supply and demand. You can have great businesses that are thriving in periods of high interest rates, and you can have terrible businesses in periods of low interest rates. And of course, that happens in real estate. People paint all real estate and real estate investment trusts in one brush. And what we see is there's obvious dispersion between the different sectors because each sector behaves very differently because of the types of leases they have and because of the supply and demand fundamentals. So you could be in a great economic environment. However, office stocks may be hurting because they're going through a secular change and vice versa.
What about the real estate investment trusts? They have seen some selling. And you reckon there's a dislocation? Values in the private real estate market have not come down as much?
Yeah, I think some dislocations an understatement. I think year to date, if you look at U.S. REITs, they're down almost 30%, almost 5% in Canada. That's a dramatic underperformance versus the broader markets. So what we find in short periods of time, REITs behave like stocks. But as soon as you go out more like 6 months, REITs behave like they should, like bricks and mortar, like the private real estate market. So your question is, what's going on in the private market? That's where we spend almost all our time because that's what we're doing is we're underwriting these public companies to see what their net asset value is, the private market of the real estate. Well, we look at the private markets and the sectors that we're focused on, and fundamentals are still strong. They still have access to capital, because that's a big question mark these days. So in the industrial warehouse market, in the residential market, single-family rental homes, you have access to capital and you have strong demand and relatively little new supply.
Andrew, we'll take a break. Always love having you on the show because we can drill deeper into a segment of the economy, a segment of the market, in this case, real estate. Andrew Moffs, Senior VP, Portfolio Manager at Vision Capital, and the questions on real estate stocks, equities, and real estate investment trusts. We'll be right back. We have an email from Glenn. Glenn is curious about Minto REIT. Do you think Minto will continue to do poorly with increasing interest rates? That's the way the question is phrased.
Yeah, so unfortunately, this Minto as a stock has really underperformed the most out of the multifamily sector this year. It trades at something like a 48% discount to its IFRS net asset value. That is a very wide discount and very attractive. So the risk reward is to the upside in buying a name like Minto today. It has been a riskier choice simply because it's been a more urban-centric portfolio. They own apartments in Toronto and Ottawa, for example, at the high end. That they suffered a bit through COVID, coming out of it quite nicely. They've recouped all those occupancy losses. And so sitting here today, the upside, downside, like I said, is more in favor of owning this stock. It's less about interest rates. It's more about migration. I read a headline today that we had record population growth this quarter in Canada. A record immigration. That can only bode well to any multifamily name in the Canadian space.
And you said Minto tends to be higher end apartment blocks?
Yeah, they have some of the upper end buildings here in Toronto as well as in Ottawa, for example.
Okay. We've got Peter on the line from Vancouver. Go ahead, Peter, please.
Thank you. Oh, Andrew, the REIT guru. May I ask your opinion on ERE.UN European REIT? It's very, very down. Is there some it has to do with the conditions in Europe? Thank you very much, REIT guru.
European residential REIT.
Thanks, Peter. European residential REIT is entirely focused on the Netherlands. I've talked about this in the past. The Netherlands is the most densely populated country in Europe. It is benefiting, at least as a residential landlord, from limited housing availability, high population growth. Simply put, people need housing. They are providing it. They have a mix of what they call liberalized units and regulated units. And I was just actually over there a couple weeks ago touring a majority of their assets. And the company is doing quite well. Notwithstanding the economic turmoil in Europe, this company is really well positioned. It is very, very defensive. Unfortunately, the stock has been, as a small cap stock focused outside of Canada, it tends to be overlooked and a bit unloved. And I think you're getting to the point where its majority owner, Canadian Apartment REIT, has to make a choice. What do they do with this entity? We think, like I said, it's trading at a very big discount to net asset value with attractive supply and demand fundamentals. We definitely think it's a buy at these levels.
Okay. We have Nick calling from Montreal. Go ahead, Nick, please.
Good afternoon. Thank you for taking my call. I'm calling with regards to InterRent Real Estate. I would just like to know your opinion on the company. I'll hang up and listen to your feedback. Thank you.
Thank you.
So InterRent, we're keeping the multifamily theme here. This one is Canadian focused, Montreal, Ottawa, Toronto, Vancouver. This is a very solid portfolio with a solid management team, a name that we own in our fund, so we obviously think it's a buy, trading at a wide discount to net asset value. Traditionally, they have been a great value add operator, meaning they buy buildings, they fix them up, and they're able to generate higher returns on the asset, and it's something they're very capable of doing in any environment, quite frankly. We think it's defensive, like we talked about. Canadian multifamily has access to capital. CMHC debt financing is a big deal, and particularly in this market, if you're starting to worry about credit, there's no concern in terms of multifamily owners. Very defensive in terms of people need a place to live, and I talked about immigration. They have a portfolio in Montreal, and which attracts a lot of foreign students. Now that the borders have opened, now that people are looking to come to Canada, I think there's an opportunity for InterRent to capture some of that growth in their Montreal portfolio where they need to capture some more occupancy.
We have another caller interested in the apartment rental space. Tony in Calgary, go ahead, please.
Yeah, I'd like to ask the guest about Killam Apartment REIT along with InterRent there, but why should I buy any of these when I can get a GIC at 4.5%? Thanks.
Thanks.
Yeah, it's a great question. GIC, you know what your return is going to be. We view real estate as a total return investment. We're not simply looking at the yield. So at any given point in time, yes, there's a great yield on a lot of these stocks. For Killam, it's actually higher than that GIC. It's a 4.7% dividend yield. But what we're looking for is that total return, meaning what is going to be the net asset value growth of that stock, and then translate it to the unit price. When you're buying stocks at 20, 30% discount to NAV, you have a lot of cushion. And if you have the right fundamentals and tailwind, I think you're going to generate a superior return to buying a GIC. There's nothing wrong with buying a GIC. It's just a very different return profile. It's frankly what you should be comping against. The question related to Killam specifically, you talk about immigration. The Maritime provinces had their highest quarter of immigration since 1951. Killam, their portfolio is concentrated over there, as well as increasing presence as we go out west towards Ontario and into Alberta and BC. That said, it's trading at a discount to net asset value. It's very attractive at these levels, not unlike any of the other residential REITs. So I'd be comfortable owning it today.
We'll be back with Andrew Moffs. He's taking your questions on real estate stocks and REITs. 1-855-326-6266. We have Neil on the line from Montreal. Go ahead, Neil, please.
Yes, hi, guys. I'd like to guess opinion on Nexus Industrial REIT, please. Thank you.
Thanks. And Andrew, just remind us, what is Nexus? What kind of properties do they have, please?
Sure. So Nexus REIT focuses on the industrial warehouse market. I'd say about 85% of their portfolio today is industrial, the balance between retail and a couple office buildings. They're on a path to being 90% industrial by the end of this year. What's been impressive about this company is they've had, I think, 15% asset growth this year. It's been a tough market to acquire assets and do it accretively, and Nexus, I think, has done a good job of doing that. They focus more on secondary markets. You think of the London, Ontario market, that's probably 30% of their asset value. London has become more of an extension of the Greater Toronto area as it's become more and more difficult to purchase and properties in the GTA. It is the tightest industrial market across North America. So London has benefited, and hence Nexus REIT has benefited. I think they're doing a good job managing their portfolio. It trades at a discount to net asset value. I would say, just because of its smaller size, other industrial REITs I'd recommend buying ahead of Nexus. But if you own it, there's nothing wrong with it. It's a good company, very solid management, and a differentiated strategy than buying some of the other ones because of that secondary market focus.
We have yet another caller on apartments. Pierre in Toronto. Go ahead, please.
Thanks for taking my call. My question is on Cap REIT. Do you own it? And where would you rank it among the other multifamily real estate companies in Canada? Thank you.
The big one, Canadian Apartment Properties.
Yeah, they are the big one. $7 billion market cap, about the largest REIT out there in terms of available float, for sure. It's a name we've owned in the past. The apartment sector has been a more difficult sector just on a macro basis. What I haven't mentioned has been some of the regulatory issues that have propped up year to date in terms of the federal government suggesting that there has to be some regulation coming for this sector as it's become so unaffordable for many to rent. Unfortunately, they victimized a bit of the public REIT sector unfairly. Cap REIT, as the largest, has taken the brunt of that. And so generally what I'd say is with that comes a bit more risk in the public markets. From a private market perspective, the market's open. The value of apartment buildings has hung in quite well. If we just saw a valuation this morning. First Capital, a REIT, shopping center REIT, sold an interest in a newly built apartment building in the Liberty Village area of Toronto at a great cap rate. So in the private market, values are hanging in. Cap REIT is trading at a discount, not unlike its peers. I think if you want to play the apartment market, InterRent is a great way to do it. It's a bit smaller. If you think M&A is going to come into the sector to close the gap in that valuation, InterRent would be a logical choice to look at. But I think highly of the management team at Canadian Apartment REIT. So if you owned it today, I'd continue to hold it.
Okay, Pierre, thanks for that question. Alex in Thunder Bay, go ahead, please.
Hi there. I'd love Mr. Moff's opinion on Granite REIT, please. Thank you very much.
Thanks a lot.
Granite is the largest industrial REIT landlord in Canada by market cap. It's focused in the United States and in Canada and in Europe. That European portfolio has been a bit of a hangover on the stock year to date. Typically, this stock is traded at a premium because of its great balance sheet and solid management team. And the market has just simply said, well, we don't want to own anything in Europe, for example, because of the obvious economic downturn going on over there. Granite trades at a discount to net asset value. We own the stock in our fund. We think it's a buy. There's nothing wrong with their portfolio. In fact, their European portfolio, which is weighted to Magna, where they have integral facilities to Magna with long-term leases, we think are misvalued by the market. So if anything, we think there's a great opportunity here to buy a great portfolio listed on the Toronto Stock Exchange in a market where it's been so difficult to buy attractively valued industrial warehouses, frankly, globally. So for us, Granite remains a buy.
Okay, we got Anne in Toronto. Go ahead, Anne.
Hello. May I please have your opinion on RioCan rate? Thank you very much.
Thanks.
So we own very few retail names in our portfolio in the shopping center side. RioCan actually is one of them. We think they're doing a very good job of managing throughout what has already been a downturn for the retail sector, managing through COVID. We took the opportunity when the stock sold off to really multi-year lows to add to begin to initiate a position, and we've added to it since. As I mentioned, our retail landlord, they also have a growing multifamily portfolio. They're very focused on development and redevelopment. And so we think they can creatively add value to the portfolio over the next 5 years and see their FFO growth, FFO being funds from operation, their earnings metric, grow 4 to 5% annually over the next several years. I think that's pretty enticing in a market like this where people are questioning earnings growth. RioCan offers you that nice blend of growth and defensiveness in terms of the type of tenancies that they have.
Okay, Anne, thanks for that question. We are going to have a look at Andrew's past picks, including BSR, REIT, and Boardwalk. That's coming up on Market Call. Andrew joined us on Market Call September 27th of last year. His first idea was BSR REIT. This one pretty flat over the period. Andrew, can you remind us what this company does?
Sure. BSR REIT is a Canadian listed REIT that operates entirely in the United States, focused on multifamily apartments in the U.S. Sunbelt. Their three major markets are Houston, Dallas, and Austin, Texas. They focus on affordable rents, more of that mid-market. And this is a name we continue to own. We took the opportunity in March to sell a big portion of our position. The stock had reached levels close to where we thought net asset value was. So it's interesting, thinking back a year ago, I think REITs are down 20% since we made this pick. The stock, though we showed, I think, up 1 or 2%. I think in March it was up 45%. So we took advantage of that. We sit here today. It's actually a name we've added to because they have a great balance sheet. They have variable rate debt exposure. Net operating income is outpacing inflation. And like I said, based on the markets they're in, those are the fastest growing cities, amongst the fastest growing cities in the United States. And so out-of-state movement of 20% for BSR. And what that means is higher income earners are coming in as renters. So we think here's a stock trading at a 25% discount to net asset value. Looks pretty attractive when the supply and demand characteristics are as good as they are.
Your next idea was Boardwalk REIT. We're talking a lot about apartment plays today. This one down over the period, but would you buy it again?
Absolutely. When I think about the apartment names in Canada, this is the one name I don't really have to worry about rent controls because over 60% of their portfolio is in Alberta. And I think that's going to be one of the last places we will see rent controls. Boardwalk, by virtue of the fact that they're focused on Edmonton and Calgary, already went through a downturn in 2014 and 15 when other REITs did not. So really this is about an occupancy story. And that's already happened. Calgary's now full again. Edmonton is just about there. And now it's about burning off the incentives that were used in order to attract renters to their apartments. So what does that mean? If you brought in a renter 2 years ago and you offered them a certain amount of time free in terms of their rent, as they come up for renewal, you still want to offer them something, but not as big as it was before. And as it continues to burn off, you have this runway for NOI growth at a time where population growth, migration growth to Alberta is high. So it's trading at a big 38% discount to net asset value, and it's a name we think is extremely attractive at these levels, amongst the best of the Canadian apartment REITs.
I mean, you say that the apartment REITs generally have sold off unjustifiably, but I mean, a lot of smart people are looking at these things. Why are they not snapping them up if they are a bargain?
That usually comes with time. And I mean, I'll give an example. 2 weeks ago, we saw the first public M&A in the United States in a while, in a couple months. And what you saw, that was in the net lease space, a very unattractive space, quite frankly, more of a bond-like space where Store Capital was purchased at a 20% premium to the previous day's price by private equity and a sovereign wealth fund. It just takes time. And I think right now there's been some question marks in terms on the residential side in Canada in terms of what the regulatory regime will be going forward. But I think once that's understood, either we'll see a rally just generally in the public markets in these stocks, or capital will come into the sector as we look at the private market, and buildings are transacting at very attractive cap rates. So we think the public markets offer that opportunity.
And finally, your final idea was Inmobiliaria Vesta, which I think is a Mexican apartment play.
Industrial play.
Oh, industrial play. I'm sorry. Okay.
Yeah, so this was a theme on nearshoring and rising e-commerce penetration rates in Mexico, and it's worked well. They have 193 properties, 32 million square feet, yet it trades at something like a 10% implied cap rate. Again, a cap rate is the inverse of a multiple. And so what you find is if you look at cap rates here in Toronto, they're 3% cap rates. To buy something at a 10 cap is really attractive, especially when there's a big tailwind going on in Mexico in terms of nearshoring. All that manufacturing that was going on in Asia, as we saw with supply chain issues through COVID, people are looking for ways to manufacture closer to home, and there's no closer place to the United States than Mexico or Canada. But of course, the cheap form of labor there makes it an attractive place for manufacturing, whether it's automobiles, medical supplies, et cetera, and Vesta continues to benefit from that.
We'll be back with Andrew Moffs taking your questions on real estate investments. Let's get back to our calls on real estate for Andrew Moffs. Sorry, Chris in Hamilton, Ontario is on the line. Go ahead, Chris.
Good afternoon, gentlemen. Thanks for taking my call.
Pleasure.
I'd like to know your view on Dream Industrial REIT. Is that worth continuing to hold?
Thanks.
I guess with a pending recession, I just wondered what the future for industrial space was. Thanks very much.
Thank you.
It's a great question, an astute question. Generally speaking, I talked about economic activity going into recession. Where do you want to be positioned? And when I said supply and demand fundamentals matter most, this is a great example. Dream Industrial focuses, by virtue of the name, on the industrial warehouse sector. 2/3 of its portfolio is in Canada. It's an urban portfolio, more weighted to Toronto. The other third of its portfolio is in Europe. And then they do have, called not perfect numbers, 5% of its portfolio in the United States through a fund that they manage. So first dealing with Europe, it's a great portfolio. I was actually over in Amsterdam a couple of weeks ago touring a bunch of their properties, and I got to see their portfolio in both the Netherlands and in Germany, which is really the focus of their European portfolio. And when I talk about supply and demand, there's no new supply. And in terms of demand, what they're benefiting from is what we're seeing globally in industrial, a very large mark-to-market in rents. What does that mean? Their in-place rents are at X, but the market rents are X plus 20%, 30%, et cetera. So you have that cushion of even if the music stopped tomorrow and market rents never go higher, you still have a very positive mark-to-market. And we're seeing that in Canada. We've seen rents double in Toronto and in Montreal. So we think Dream Industrial, in terms of its valuation, is really overly discounted at this point. It's similar to Granite because of its European portfolio. It is sold off, but we think it is really at a point where it's incredibly attractive. And we think they'll have solid earnings growth over the next couple of years. So notwithstanding what will go on in the broader market, here's a stock that, because by nature of the fact it's in the industrial warehouse space and the supply and demand fundamentals are as attractive as they are, we believe it'll do quite well. So we think it's a buy.
Okay. We have John in Toronto. Go ahead, John.
Hi, guys. Love the show. Long-time viewer, first-time caller.
Good. Thanks.
My question is, it seems that all the REITs that trade on the TSX are trading in U.S. dollars. And I'm wondering if there's any that do trade in Canadian dollars. And if not, would the CDRs that the IBC have come out with, would that be a way of getting in at Canadian levels? Thank you.
So if I could take a stab at that, just to clarify, there are several REITs that own U.S. properties or properties outside of Canada that have U.S. dollar listings. The majority of them also have Canadian dollar listings. So you have to check carefully whether, depending on where you're punching in the ticker, if it's .u or .un or /u or /un or -u, et cetera. Meaning, BSR REIT is a name that we own. We talked about it earlier. The ticker is HOM. You can buy it in U.S. dollars or on Canadian dollars or in Canadian dollars. So I advise you, if there's a stock that looks interesting to you, go on the company's website, the investor relations section, and you'll find the right ticker for you, whether it be in Canadian dollars or U.S. dollars.
Would one thing that might be throwing John off here is the fact that the symbols are .un?
It's quite possible as well. All that means is that those are they're units. Technically, REITs are not corporations, they're trusts, so they issue trust units, not shares. So that is the distinction that you find on the Toronto Stock Exchange.
But all of them do trade in Canadian dollars, but some, sorry, did I mishear you, some have a US dollar option as well?
Correct, if they have US dollar assets.
Grant, thanks very much. We have Kevin calling from Calgary. Go ahead, Kevin.
Hey, how's it going? Thanks for taking my call. Just wondering if you guys could please comment on Choice Properties REIT and if it's a good buy for long term.
Choice Properties, okay.
Yeah, so Choice is the largest REIT in Canada, just to correct myself from earlier. Just doesn't have as much of a float just because of its parent company, the Weston Group, owns such a large position. It's probably a $9 billion market cap, almost 6% distribution yield. Trades at discounts to net asset value, but certainly not as wide as some of the other REITs that we've talked about already, more like a 12% discount in NAV. It's a diversified REIT. However, it's really concentrated in retail. Call it 3/4 of its assets are in retail, and that's very defensive, typically Loblaws anchored shopping centers. A growing part of their business is industrial. 15% of its portfolio, and growing nicely, is in industrial, and they have a great management team. This has traditionally been the REIT that's been quite defensive, and hence it is a name you would want to own for the long term. Solid yield, nice growing cash flows, and just like its parent company, it thinks for the long term. So if it's thinking for the long term, it's certainly an investment that you can think about for the long term and create value over that period of time. So it's a name I'd be very comfortable holding if you do already.
We'll be back with Andrew Moffs of Vision Capital, and Andrew is taking your questions on real estate stocks and REITs. 1-855-326-6266. Nick is on the line from Toronto. Go ahead, Nick, please.
Yeah, hello. Can I please get your guest's opinion on Morguard North American REIT? It seems to be trading at a very, very low PE ratio, and the margins seem to be very good. Is this company not a screaming buy? Thanks for your response. Have a good afternoon.
So Morguard North American Residential REIT, in the residential sector, focused in both Canada and the United States. It's externally managed by the parent company Morguard Corp, ticker MRC, and the ticker is MRG.UN. This stock always trades at a discount, whether it's on net asset value, whether it's on earnings ratio, earnings multiple, and that's by virtue of the fact that it's externally managed. And it does own good assets. They operate well. That said, there's better opportunities within the residential space. If you want to buy apartments in the U.S. Sunbelt, I'd point you towards BSR REIT. If you want to buy apartments in Canada, I'd point you towards InterRent. And both those names do not have the structural challenge of being externally managed by a parent company.
Okay, so would you steer clear of it then, Andrew, as a rule?
Yeah, there's periods of time where it does make sense if the discount gets too wide. Sitting here today, the discount is just as attractive elsewhere in some better structured REITs.
Okay. Let's head to Barrie, Ontario. We've got Mark on the line. Mark, fire ahead, please.
Thanks for taking my question. Great program. Congratulations.
Thank you.
I'm wondering about Allied Properties REIT on the TSX. They've done so well for so many years with excellent properties, and now they seem to have hit a bit of an iceberg. And I'm just wondering, to what extent might there be a problem in the future with them having to repurpose a lot of their spaces if the trends in office buildings continue like they seem to be? Just wondering what your guest might think about that.
Thanks.
Yeah, Allied is focused on the office space. And by virtue of being in that sector, it has just been challenging for them in the public markets. The public markets have said office is not a sector you want to be invested in. And Allied, just like Dream Office, for example, has suffered. It's gone to the point where it's trading at quite a wide discount to net asset value. I've been on the program for many years, and we've just generally steered clear of the office space prior to COVID. Post-COVID, the big question mark is work from home. What will be office utilization going forward? We seem to be stuck at, 45% utilization in the office space currently. And meanwhile, people have no problem going to baseball games or hockey games or traveling or et cetera. So there seems to be a bit of habit forming. And so the question is, what will happen to demand going forward? The good news is Allied does have great buildings, and they're generally well located. And the question mark is always, well, what is an alternative use, if that is the question on the table? And they would all have great alternative uses. That's just not necessary today. The office game today is about called musical chairs, and the better space will prevail. It'll just cost more to get those tenants. I think Allied falls in that camp of having good space. Tenants generally want to be in their buildings. So what will be the cost to acquire those tenants? And Allied is probably well equipped to fight that battle. It's just going to be a bit of a headwind, whereas a lot of these other sectors we've talked about have a tailwind.
Sorry, a lot of the other sectors, what was that final thing?
Have a tailwind. When you have a market in rents, for example, in industrial, where you don't need to have any further market rent growth, yet you'll have earnings growth. The opposite is happening in the office space, where you're coming off record rents, and now you have to pay a lot of tenant inducements to occupy your space, whether it's free rent, whether it's offering to improve the space, et cetera.
Let's head to Vancouver. Al is on the line. Go ahead, Al, please.
I would love to get your thoughts on ProREIT, please.
Thanks. And can you remind us what ProREIT is, Andrew, please?
ProREIT's a small cap Canadian REIT, diversified REIT. More than half of its assets are industrial warehouse, which is a sector that we like. About 30% of its portfolio is in retail. And they're trying to grow more and more as an industrial warehouse REIT. At this point in the cycle, it's been difficult to grow in the key markets. So they have focused more on some secondary markets to try and find higher yielding assets, given they have a higher cost of capital than some of the other industrial warehouse REITs. We think there's better opportunities elsewhere, and we've talked about a bunch of the industrial warehouse REITs already in the program. I don't think in this market you get paid to buy diversified REITs.
Okay. We are going to take we got one more caller. I'm sorry. I was trying to, sorry about that, Marlene. I was hoping to hear from you. I think you're in the beautiful Rocky Mountains of Alberta. Go ahead, please.
Yes. I would like to ask Andrew about H&R REIT, because it seems to be going down quite a bit lately. Should a person continue holding it?
Thank you.
I like the transition that H&R REIT is making. This has been the original diversified REIT, so to speak, in many asset classes. And they're on a path to simplification, really with the North Star being residential in the U.S. Sunbelt and as well as industrial. And what they're doing with their office buildings is where they cannot create value, they're going to sell them. Where they can create value, they'll redevelop. And then they've already spun off their mall business into Primaris, and that leaves them with some other assets which they'll dispose over time. This is a work in progress. It's all about management execution. So far, they're executing well. And that said, like I talked about the previous stock, when you're a diversified REIT, it's hard to get a lot of love in this market. So I'm surprised that it's underperforming as of late. It actually had done quite well going into this latest period of time in the REIT market. It's, like I said, it's an execution story. We like the asset classes that they're looking to focus on. We're already invested in some of those. If you own it, that's your risk reward today, is can you think management execute on selling and redeveloping assets in a tougher market?
Okay. Speaking of the Rockies, I was in Banff earlier this year and I went for a little hike out of town, and I didn't realize how much more tiring vertical hikes are in any... Let's get to those top picks. Andrew's first idea is Tricon Residential.
Yes, we talked about being defensive, and I think this is one great way to play it. Tricon focuses on the single-family rental home sector in the United States. This is a very defensive asset class. If you think about it, they focus on the cohort between 35 and 44 years of age. These are people that need homes, yet given home affordability today, are priced out of buying homes. This cohort is going to double, their growth is going to be double that of the broader population over the next 5 years. So they need somewhere to live. They can't buy a home. They can now rent a home at a cost that's 36% lower than the average condo. And so when you look at that backdrop on a supply and demand basis, and then you think about defensively, they have the highest mark-to-market, meaning they have a 20% gap in terms of their in-place rents and market rents. That's a great thing to have in this type of market. Yet the stock trades at a 30% discount to its market value. And if you think intuitively, they own a portfolio of homes. In theory, you could go off one by one and sell off all these homes. Of course, as a portfolio, you could actually get more because institutions have really gravitated to the sector. So we think it's a very cheap stock with great earnings growth and a great management team.
Okay, your next idea, First Capital REIT.
So an extension of the defensive theme, First Capital owns the best grocery-anchored shopping center portfolio in North America, probably globally. This is a very defensive asset class when you have 85% of your tenants as necessity-based retailers, whether it's grocery stores, drug stores, et cetera. What's so surprising to us, given they have the best portfolio, they've been the biggest laggard amongst their peers. If you look over the past 5 years, their peers are up 35%. First Capital, the stock, is down 12%. Yet they've generated great returns in terms of earnings, in terms of what they can do on new leases, et cetera. The IFRS values north of $24 and the stock is below 15. That is a really wide gap, and I think something structurally needs to be done here, just given how cheap it is. You're starting to see the company act on that, selling assets in order to close that gap and buy back shares. And I think more eyes are going to be on this because when you have such a great quality portfolio trading at such a discount to net asset value, typically something has to give. And we think the risk reward is definitely to the upside here.
And then finally, Summit Industrial Income REIT.
For us, this is the best way to play industrial warehouse in Canada. Simply put, their main focus is Toronto and Montreal. Those are the best markets in North America, where you're seeing rents increase 35% and 60% between Toronto and Montreal, respectively. That's huge. And so they're already sitting on a very big mark-to-market. They're seeing leasing spreads at double what, when leases come up, they're signing leases at double the expiring rate. It trades at a 33% discount to NAV. If I had to pick a name for M&A activity in industrial, this would be the one. They've done it in the past with their first iteration of Summit back in the 2000s, and I see no reason why they wouldn't want to do it again. And we think it's a great company, irrespective of M&A. You will have great earnings growth out of this vehicle.
And what about distribution growth? Have they been consistent in that area?
Yep. What we like is that's a lower yield, about 3.5%. What you typically like to see is REITs retain their cash flow, particularly in this type of environment, because they can use that cash for accretive activities, whether it's reinvesting in their properties, buying new properties, or frankly buying back their stock. That's probably the most attractive thing they can do today. So we like the idea of having a low yield. And then to your point, they have the room to increase it every year.
Yeah, it's interesting though, isn't it? The unit's down about 29% this year, worse than the broad market.
And that's the opportunity. We have so much capital sitting on the sidelines waiting to invest in publicly traded real estate. You have the Blackstones and Brookfields of the world that have raised these large private REITs with tons of capital. They're just waiting for the all clear sign in terms of credit markets and capital markets. And when they do, this is the quickest way to buy portfolios, i.e. buying public companies that trade at discounts. And that's stunning to us, where you have these small periods of time where there's big dislocation in the public markets. In my career, I've always seen them turn into the best opportunities.
Okay. That's right. You take advantage of other people's fear and you can sometimes make money. Thanks very much, Andrew. It's always great having you on the show.
Thanks again for having me.